Good morning and welcome. This is Shane Keith, and I'm here with Wes Crill. We're going to welcome you to another podcast of the KDI Wealth Alchemist. Wes Crill went to school, spent North Carolina University, correct, Wes?
That's correct.
Okay, and spent 10 years on Dimensional's research team, and then now, as of this year, is the Client Solutions Director with Dimensional. Anything else you want to add to that, Wes?
No, I think you hit all the high points.
Perfect. We're going to hop right into this. Dimensional is one of the solutions, and I would say probably our preferred solution from an investment strategy perspective in our investment strategy team. So let's just, as we roll into it, Wes, from a big picture, how would you describe Dimensional's core philosophy and process when it comes to their investments?
Yeah, our philosophy has had really, I would say, the same basic tenets since we were founded in 1981. And there's really three critical components to it. The first is that we employ a rules-based investment process. And what that allows us to do is communicate what these rules are so that our clients have transparency around what we're doing. They understand how to monitor our strategies, understand the types of environments in which they will do well or not fare as well. And so it's just a way to really help our clients understand what we're doing within our investment process. We also believe in the use of market prices. Market prices are really the best prediction of the future. And because of that, they have a lot of information when it comes to the expected returns of different securities, the risk associated with different securities, and we can use that information throughout our investment process to increase return or manage risk. Now, that also implies if you're using market prices, well, prices change every day. And so we think it's critical to have a daily investment process that allows us to master the trade-offs or balance the trade-offs on a daily basis based on new information. And then, of course, at the end of the day, we think that flexibility is a really critical component of what we do. We want to be able to have flexibility when it comes to buying and selling of our securities, again, based on up-to-date information.
Thank you for that. And so, especially with today's day and age where everybody is an investment guru or will invest for themselves, how does Dimensional go about not getting caught in the noise, or as you start to see on kind of the growth side of the market where we see PE ratios a little bit out of whack, or for example, the Mag 7, how does Dimensional handle something like that?
I think this is the important part of having an investment philosophy because it gives you something that you can adhere to through thick and thin. A big part of ours is using market prices. We use market prices as a guide to inform, for example, how much we want to hold of certain securities or how much we want to overweight certain securities based on higher expected returns. And we now have multiple decades of academic evidence to show that trying to outguess markets has not been consistently successful. Trying to figure out based on what's been going on recently, whether certain security prices are too high or too low, is not going to be a consistently winning approach to delivering better than market returns. And so we find the best way to approach anything that's happening in markets is to stay consistent and to keep consistent exposure to asset classes, because when it comes to the sources of returns, whether it's the broad stock market, whether it's certain areas of the market that we believe offer higher expected returns like small caps, value companies, or high profitability companies, we don't know when those higher returns are going to show up. And so we want to make sure that we have consistent exposure and don't deviate from the investment rule set.
With that investment rule set, we have, for example, from a domestic front right now, you have a couple of different proposed legislations, but let's talk through the proposed tax legislation being discussed right now and currently in the Senate. Is there any adjustment that Dimensional does from that perspective, or as you guys start to see how that's going to play and unfold, what approach do you take?
Yeah, the tax policies, unfortunately, are out of our hands, just like they are for most investors. But what we can control is how we incorporate those changes into our investment process. And I'm going to try out the F word again, not the bad F word, but the word flexibility here, which is critical to being able to manage the trade-offs associated with different tax policies. And that starts with the securities that we even have eligible for our portfolios. So, for example, if you take something like a real estate investment trust or a REIT for short, because they're pass-through entities and they're passing through income to investors, that tends to be taxed at a higher rate than certain types of dividends. It's not what we would call a qualified dividend income. And so, because it's a high distribution asset, we will exclude that from most of our equity portfolios. We have REIT portfolios separately. This can be used to customize property exposure, but that's one tool we can use to minimize one element of tax exposure, which would be non-qualified dividend income. And then, of course, there's a flexibility when it comes to what we buy and sell on a daily basis. This can work in a number of ways. This can help avoid having short-term capital gains because we can determine when we want to sell a security. And it also helps us, again, going back to that idea of qualified dividend income, we can seek to maximize how much is going to be qualified by satisfying some of the requirements, particularly when it comes to the holding period timelines around when those dividends are paid. And so that gives us sort of natural advantage to balancing the trade-offs, as I say, when it comes to different tax policies. And certainly we have the flexibility from an infrastructure standpoint that as those rules change in the future, we might seek to adjust our methodology for managing the portfolios.
So this is a question that comes up all the time with clients. And again, something that we talked about, staying the course, but when markets become volatile or headlines dominate, as we've seen in recent months, with investor sentiment, what principles help anchor your team's decisions and keep clients grounded?
The number one idea for me is this idea that markets are forward-looking. So when you experience that volatility in markets, especially when it's on the negative side, what's happening is you're observing firsthand the market resetting its expectations for the future when it learns something new. It's an incredible, efficient information processing machine. Now, the upside of this is whatever the source of pessimism might be. I'll take a glass half empty approach here and say that maybe the volatility is being driven by worsening expectations for the macroeconomy, for things like tariffs, for maybe global warfare or things like that. Those effects, when I think about the macroeconomy, are felt really over the long haul. Like the actual outcomes from whatever these pessimistic events are, they're going to be felt over a long period of time in terms of the economy. The market makes you feel it right away. And the benefit of that is that once those expectations have been incorporated into market prices, you can still have a good outcome from markets, even if you do end up with a disappointing set of circumstances. We don't have to look that far in the rearview mirror, by the way. If you go back to the year 2023, where there were a number of sources of consternation, whether it was political events, the economy. We had the onset of the Gaza conflict that year. We had a debt ceiling crisis. We had very nearly a government shutdown in the fall of 2023. Yeah. And despite all that, global stocks were up more than 20% for the year. So I think that's something for investors to keep in mind, that just because you're worried about the news headlines doesn't mean that you should stray when it comes to your investments.
When, in terms of investor behavior, so what common mistakes or misunderstandings do you see when it comes to interpreting news or reacting to current events? So just adding on to some of what you just answered.
Yeah, I think it's feeling like they have to be doing something. That in most scenarios in life, when we have a change in the inputs, then we change something about the outputs. So if our circumstances or things like that are changing, if we're learning something new, we feel like we need to be changing up our process. When it comes to investments, because this is getting incorporated into market prices so quickly, oftentimes changing course is the wrong move. And we saw a lot of this back, I would say probably the closest parallel to the current environment is the onset of the COVID pandemic. Yeah. And we did see a lot of flows out of equity funds and into money market funds. I mean, hundreds of billions of dollars flowing into money market funds in March of 2020. Well, then what happened over the ensuing months? Well, over the next 6 months, global equity markets returned more than 20 percentage points. The actual S&P 500 ended up positive for the year, which was really difficult to fathom when we think about the declines in February, March of that year. So I think to the extent that investors can avoid reacting to something that has probably already been priced in and the market has already moved on is a really excellent way to preserve your wealth and to avoid the opportunity cost of markets rebounding after you have divested.
We consider ourselves a value-based shop of an investment strategist. With the way that growth has performed over the last decade, what would be your advice or guidance for someone looking to either be value oriented or growth oriented during this time?
Yeah, value we think is a core driver of expected returns within stocks. And for the main reason being it's telling you something about the price you're paying relative to the fundamentals of a company. So the lower the price relative to, say, a stream of future cash flows for an equity security, the higher the discount rate. And that discount rate is the investor's expected return. Another way to think about it is this is a rate of return being demanded by the market to hold a stock of this company. And that rate of return being demanded is based on whatever the current information set is and whatever the expectations are for the future based on what we know now. Now, information sets can and do change through time. And I think that's really when people think about the difference between a realized return and an expected return. The realized return is going to include the component of stuff that we could not have seen coming, that was an unexpected development for a company. Now, when it comes to growth versus value in the US, it's reasonable to assume there's been a lot of unexpectedly good developments for growth companies. For example, I would say the hood ornaments of this movement have been the Magnificent Seven stocks. In 2023 alone, that group of 7 stocks collectively grew their market cap by more than 70%. So 70% cannot be an investor's expected return. That is far too high to be the cost of capital for a company's equity issuance. So that tells us that a lot of things went very right for those companies. And to the extent that the unexpected component is not going to persist going forward, which is the very definition of unexpected, you would not expect it to persist going forward, then that would mean that value should be outperforming growth. But it kind of explains why you had a windfall for growth over that time. It also explains why when we talk about value underperforming growth in recent years, that's really a U.S. specific phenomenon. If you go outside the U.S., value stocks have outperformed growth pretty handily over the past decade, whether we're talking about non-U.S. developed markets or emerging markets as well. So I think this is why we spend so much time, number one, trying to educate and set expectations around the value premium, starting with the theoretical backstop. Why do we believe in this before we look at the data that helps us persevere through disappointing stretches for the value premium? But also looking back historically, we can show that there have been instances where the realized performance of value stocks has been disappointing. This is not a new event or a sea change event when it comes to markets. And I think those things kind of help us restore faith when it comes to the value premium.
So, with your current role with Dimensional, you get to be, to some degree, the voice and get to share a lot of educational content and material out from Dimensional. What's the next piece that likely comes out from Dimensional as well as you, Wes, either on current events or what you guys are looking to next?
Yeah, we're always trying to cover current events. We're probably going to have some stuff coming up soon, just commentary on the nature of geopolitical risk as, we see the Iran conflict boil over a little bit. But we also, I think, can find evergreen principles to address things that are happening in the marketplace because market participants are always looking forward and investors are always kind of waiting to see what the next shoe to drop is when it comes to news headlines. And so things like inflation concerns, interest rates, expectations, macroeconomic developments, whether we're going to have a slowdown in the economy or not, all of these things I think are top of mind for investors. And I think part of the fun, or some people might consider it a challenge, is to find new ways to address what I think of as largely evergreen concerns about the marketplace. And then to the extent that we have developments in terms of the investment infrastructure, I think this is really fascinating when we think about something that we're sort of on the bleeding edge of trying to accomplish right now, which is to get SEC approval to have, for example, ETF share classes attached to our mutual funds, or try and meet investors where they are in terms of our different investment offerings. And I think this probably hits to the concept of what else should investors be thinking about. I think the whole active ETF fund movement has been sort of interesting, that investors seem to be taking on more and more interest in active ETFs without totally understanding that the ETF wrapper itself hasn't really solved all of the issues with the active fund landscape. That some of the things that we have seen traditionally, like higher expense ratios, higher turnover, those things seem to be manifesting even in these active ETFs, which some investors might not have expected if they thought active ETFs we're going to embrace some of the characteristics of index fund ETFs. So those are some of the things that I think are interesting to me these days. And I always, as always, love to get the feedback from advisors like yourselves to tell us what our investors are really wondering about these days.
Yeah, I think you're hitting the nail on the head there. And of course, ever since ETFs launched, they've taken the industry by firestorm. I think you're spot on when we're looking at active ETFs. They're carrying some of the same principles, or at least some of the same drawbacks that we saw in the mutual fund space. It'll be exciting to see where that goes. One additional question that I have, and let's say we have a brand new investor just starting out. What's two or three pieces of advice that you'd give that investor for the long term from an investment strategy perspective?
Yeah, the first is think long term. So you don't want to get caught up in the shenanigans of trying to completely reevaluate your portfolio every 3 to 6 months based on what's been happening in the marketplace. Because again, the historical evidence suggests the best approach is to just stick with it for the long haul. And then I think the more that you can embrace investing as being boring, those should be the traits that you associate with investment. It's like watching paint dry. It should not be like betting on a horse race. And so I think that's a helpful referendum when you're evaluating whatever the flavor of the month is, because we see fads come and go in investments all the time. And a lot of times these are presented as, really the best way to invest in the current market environment, or it's a sea change event when it comes to the way you can interact with financial markets. I think a lot of times those promises are going to end up being hollow. And so the tried and true approach of having an investment philosophy, hopefully it is involving the long term, and then thinking about what that implies for long-term investment solutions, and then focusing on controlling what you can control. You can't control what markets are going to do, but you can control how much you pay in terms of fees, right? Based on the funds you pick or the wealth management that you have. And then, what kind of investment solutions are these? Very narrowly focused investments, maybe only devoted to a certain sector, or are you getting broad market exposure? And then I think considering working through an investment intermediary. I find with almost anything I do, it's helpful to have some objective advice. For example, I use a personal trainer, not because I can't count to 10,
Right.
but because it really helps to keep me convicted in what I'm doing and keep me on track towards my goals. And I think investments can similarly benefit from that type of objective advice.
Yeah, that's great feedback and advice. I would tell you that you talk about investment fads, we bring it up all the time with our clients. It wasn't too long ago that NFTs were the new hot thing,
Yeah.
and now
Yeah.
something that's not discussed at all. Thank you for your time, Wes. Thanks for coming on.
Yeah. Thanks for having me on. I really enjoyed the conversation. Hopefully we get to do it again soon.